Credit, credit, credit. What did Jay-Z say in that one line? What's more important than throwing money in the club? Credit. Bonjour, Daja How. Hello everybody and welcome to my first YouTube video. So I've been learning quite a bit about the world of money and finance for the past 2 to 3 years and have decided to start this YouTube channel as a way to build a community with which I will share what I've learned so far, share more as I learn more, and to have an opportunity to learn a thing or two from you guys. In today's episode, I want to share my experiences in learning about the world of credit, particularly credit scores. And to do so, I'll start off by sharing why credit scores were started in the first place, the consequences of a bad or a low credit score, how to build a good credit score, and where you should start. Hopefully, I'll do this in less than 5 minutes. Let's start the clock. Remember that one friend of yours who asked for $20 and never paid it back? Yes, they never paid it back. Well, as a bank, that's the exact same problem you never want to have. People who don't pay back their loans. Well, what can we do about it, you ask? With that question came the establishment of credit bureaus, with the three most popular being Equifax, TransUnion, and Experian. These bodies, the credit bureaus, were responsible for providing credit information for people applying for credit, be it loans, mortgages, and so on. And they each had their own intricate way of providing this information. And in search for a simpler, more standardized way of credit reporting which everybody could understand, Equifax hired the Fair Isaac Corporation, more commonly known as FICO or FICO. And they came up with an idea of using a 3-digit number between 300 and 850, which measures your credit worthiness. Sort of like a health bar in a video game. And this number, this FICO score, is what's referred to today as your credit score. And the higher your credit score, the more you can be trusted with credit and the more credit you can be trusted with. But what if you don't have a high number? What if you have a low credit score? Well, real quick, let's just get through the consequences of having a low credit score. And the consequences of a bad credit score: number one, having your loan applications decline, not being able to get a mortgage, not being able to finance a car, not being able to open a store account for clothing, electronics, or household items, etc. And should you be able to get the above, should you be able to get a loan, you might find yourself paying a higher interest rate than someone with a better credit score. But what is a good credit score? What is a high credit score? And how do you get it? And by the way, this is not financial advice. Contact a registered financial advisor if you want financial advice. This is entertainment. Just as some infinities are bigger than others, credit scores are not looked at the same. So what is a good credit score? That's a bit tricky to answer. Let me put it this way. Remember earlier when I said FICO had this brilliant idea of coming up with a 3-digit number to measure everyone's credit score? The problem is, other financial institutions did the same. Equifax have their own 3-digit number, TransUnion have their own, Experian have their own, even banks have their own. So it's kind of difficult to then say this number is better than that number if two different people are not using the same number. In fact, you as an individual have different credit scores depending on whom you check it with. For the sake of this video, I'll use the credit score system that is used by ClearScore. And with that, the average credit score in South Africa is thus 560 out of 705. So any number above this average is pretty good, and the higher you go, the better. When you start dipping below the level of 450 out of 705, that's when red flags show up. And so you might ask yourself, how is my number even calculated? And that's what I'll look at next. Here's a quick breakdown on how your credit score is calculated. So the first thing that they look at is your payment history. How well have you been paying your debts? And this accounts for 35% of your credit score. Next is your credit utilization. Out of your credit that you're allowed to use, how much of that are you actually using? If you're allowed 100,000, are you using the whole 100,000 as debt or just 10,000? The lower your credit utilization, the better. And this accounts for 30% of your score. Next, how long you've had your credit for. Obviously, someone who's had credit for longer is seen as better than someone who's just started having credit, because we're not sure if you'll pay back your debt. Next, your credit mix. How many different credit items do you have? And lastly, new credit. Every time you apply for a credit product, like credit cards or student loans, it affects your credit score, because this is seen as someone who's maybe desperate for credit, or is looking for new credit. Maybe their finances are not in order. This is not always the case, but just keep that in mind. So where to start and what to do? The first step in building a good credit score is knowing what credit score you have to begin with. And to do this, you can go to the ClearScore app or go to their website, clearscore.com, and register there. As much as I wish this was sponsored, it's not. This is just the app that I use. And then I also recently found out that you can use the Nedbank Money app to check your credit score. Honestly, I wish and I believe that every banking app should be doing this. For some odd reason, they're not, but you can use the Nedbank Money app. That's if you're in South Africa. And yeah, here's what mine looks like. Let me know in the comment section what you use to check your credit score. If you don't mind, let me know what your credit score is, and I'll see you in the next one.